I'm Charlotte McLeod with the Investing News Network, and here today with me is Jonathan Lee, founder at JGL Partners. Thanks for joining me today. This is our first time speaking. I wanted to ask if you could start by telling me a little about yourself and your background in the lithium space.
Sure. I started out about a decade ago on the sell side, doing equity research, covering a lot of lithium names. Then transferred to the buy side, where I worked at a firm called JGL Partners. Their largest position was Lithium Americas, which is a kind of an in vogue name today. And subsequently, I'm a consultant to various buyers of lithium currently, and I'm on the advisory board of a company called Baring Lithium.
We're here at Minds and Money in New York, and you just spoke on a lithium panel. One of the topics was how best to invest in the sector. What are some misconceptions that you tend to see from investors?
Yeah, I think this is very similar to how everyone thinks about mining in general. There's always this perception that every mine will get built. Much like the mining space, over 90% of them will fail. And so when we think about supply-demand dynamics, I think there's actually limited number of new mines that will come online. And then secondly, the fact that when we look at past history, most of these new mines have had hiccups in the production standpoint, and so they either underproduce for the first few years, or they've taken a number of years to produce, or some have gone into bankruptcy, all within the last decade. So I think those are, on the supply side, those are all various different caveats to take into consideration when we think about the lithium supply demand dynamics.
Lithium's a very hot sector, and there's lots of information out there that people can look at. How would you recommend investors go about educating themselves about lithium? What are the resources they should use?
Yeah, that's a difficult question. I would say there isn't much sell-side research out there, at least very comprehensive. I would say that you're thinking about three things. You're talking about management, finance, and then technical aspects, and I think all three of those are important. And generally speaking, you have to do a pretty big dig on each one of those. I don't think there is really one resource to get all three of those, but the sell side research would probably have best about just generally speaking finance. From a management standpoint, it's actually really talking to management and getting their goals and their background and their thought processes. And then with respect to the mine itself and operational, it's a very human capital and engineering type of experience that takes a pretty long time to understand.
Let's return to the question of how best to invest in lithium. What's your opinion, and what are your criteria when you're picking stocks?
Yeah, so I think generally speaking, the stock is valued as the present value of all future cash flows. Right? That's general, and so that takes into consideration time to production, management, how much dilution, capital structure. So there's various different ways of looking at a company and creating a fair value for it, and seeing that it's undervalued. So I think that's probably the best way to sum up how to look at investing. But I think all those different pieces come into play: management, capital structure, and actual asset level. So that includes metallurgy as well as asset size.
The lithium market is compelling in large part due to anticipated demand from electric cars, but there have been concerns about oversupply lately. Is that something investors really need to worry about right now?
I know there's been a lot of talk about that. I could talk about having clients that are looking for lithium concentrate right now, and the market is tight. We expect it to be tight for the foreseeable, or at least in the near future. There is, when we think about oversupply, again, we talked about how some at least some research talk about how there could be an oversupply because of new mines coming online and the massive amount of supply coming online. But I think, to be a caveat there has been every mine that has come up online has been delayed. And secondly, most of these companies will not get financed production. And on a project level, if you look in the past, most of the projects that have been financed with at least a piece of debt, which most projects are. That debt has come from a strategic partner and not from banks, and so you can see the the hesitation from traditional banks to get involved in the space. And so, if it's strategic partners that are putting up the debt financing, where that material is going to go. Is going to go to most of that material goes to that debt financing partner, and so you kind of limit the oversupply issue that people have been talking about.
Last question. Do you have any final advice for lithium investors this year?
When we think about oversupply, I think you have to bifurcate two different things. One is the carbonate price, and then one concentrate. Typically, on a hard rock side, you produce concentrate first, and then you convert it with a converter to carbonate. There's been a lot of talk about new mines on the concentrate side, but I don't think there is enough capacity on the conversion to carbonate that may actually have a bifurcation where you see higher amounts of concentrate on supply and lower amounts of carbonate, and thereby you seeing a dichotomy of pricing for concentrate as relative to carbonate, where I think will hold up pretty well.
Okay, well, thank you. That's all from me. It was great to have you today. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Jonathan Lee.